In the last class, we have discussed something about the money market. What is a money market? What are the different sub-markets exist in the money market? Today, I am going to deal with the various institutions which actually participate in this particular money market. There are two basic institutions apart from the government which actively involve in the money market. Not that the corporates are not going to involve themselves in the money market, not that the individuals are not going to actively participate in this particular money market, but the major activity which goes on in the money market is done by the banks and the various other financial institutions. The financial institutions actually actively participate in this particular money market. The vibrance of this particular money market depends upon the commercial banks that exist in a particular country and the financial institutions that exist in a particular country. So it is very important for us to understand the concept of a bank and the concept of a financial institution, how the banks are different and how these particular financial institutions are different. To understand a bank, we need to understand what it actually does. A bank is an institution whose debts are accepted in final settlement of other people's debts. What do you mean by these particular things? They collect the deposits in the form of a debt. They collect the deposits from the various individual in the form of a debt, and they, after getting this particular money, will lend it to some other persons. So in simple, banks are the institutions whose debts, usually referred to as bank deposits, are commonly accepted in final settlement of other people's debts. So the banks actually involve themselves in transferring money from one individual to the other individual. They actually pump in and pump out the money from one individual to other individual. This particular process is what is called financial intermediation. So they collect funds from one person, they lend it to some other person. This is what a bank does. So we have different kinds of banks. The kinds of banks can be divided on the basis of its origin. Say, Citibank is there. We have Standard Chartered Bank is there. They are considered to be foreign banks. We have State Bank of India and other State Bank of India and other banks which are working in India whose origin is in India. Apart from these particular things, whether government owns these particular banks, whether the private parties own these particular banks, on the basis of that particular thing, we can also further divide these particular banks into publicly owned banks and the privately owned banks. We call them as government banks and the private banks. Apart from these particular things, on the basis of the work they do, the way these people work, we can also further divide these particular banks into the urban banks and the rural banks. That's why we have some RRBs, regional rural banks. Apart from these particular things, we have the cooperative banks. These particular cooperative banks have come into operation because they wanted to help a particular group of individuals for a particular cause. So there are various kinds of commercial banks which have come, cooperative banks which have come in India. They are working for the welfare of a particular group of individuals, or they are working in a particular location, helping the individuals in a particular area. So there are various kinds of banks which have come, and the operations are different. There are the way they do the things are different, their activities are different, and on the basis of that, actually, the banks can be divided into various categories. For example, there are certain banks which are actually doing a lot of work in microfinancing. So they are doing microfinancing job wherein they give funds to a select group of individuals. They give small loans to a certain segment of individuals who are in a small business, very small business actually. So there are microfinance, these people are actually giving lot of trust or giving lot of loans to microfinance institutions, directly or indirectly. And this is the kind of work any bank does. So there are various functions they involve with. So this particular banks in general, to be in specific, can be divided into 3 categories of banks. 1, retail banks. Then we have what is known as wholesale banks. We have some international banks. So on the basis of the functions, actually, the banks can be divided into the retail banking, the wholesale banking, and international banking. So on the basis of this particular functional area, these functional operation, the banks can be divided into retail banks, wholesale banks, and also the international banks. Of course, a particular bank might be doing all these particular things actually. So we cannot call SB as only retail bank or a wholesale bank or an international bank. So we need to understand that a particular bank may be having more emphasis, they might be putting more emphasis on the retail banking activities. Some other bank might be doing more of international banking activities. So let us understand what this particular things we are talking about. That is, what is retail banking, what is wholesale banking, what is international banking. So what is a retail banking? A retail banking is all about giving importance to individuals' multiple banking requirements. Retail banking is all about giving more and more trust to the multiple banking requirements of an individual and considering them as a separate business division and giving special attention to this particular group. So these particular banks these particular banks actually put more emphasis on the individuals and their needs, then it is going to be considered as retail bank. So what these particular retail banking activities are? The retail banking activities can be divided into the activities relating to the accounts and deposits, activities relating to loans, activity relating to the retail services. With regard to the accounts, actually, these particular banks will be having different kinds of deposits. We have savings bank account. We have wherein a small individuals will be putting small amount in this particular bank in his account, and these particular individuals will not be bothered about the interest that this particular bank is going to give, but it is a facility which they wanted to use. It is considered to be a payment facility for which these particular individuals will be opening this particular savings account. Savings account is an account wherein I can put my money, wherein whenever there is a need for money, at a short notice, I can borrow that particular, take away that particular money or borrow that particular money from that particular my own account. And this particular savings account also gives me a payment mechanism through which I can make payments to the various individuals. The payment mechanism can be done through a check which is going to be given to me whenever a bank account is going to be opened in any particular bank. Of course, nowadays it is not only the check which we are using to make different payments. We are aligning this particular savings bank account with my the digital wallets, and I can make payments through my digital wallet. I can make payments through my internet banking. I can go for a payment through a debit card which is attached to this particular savings account. So opening a savings account helps me in making various kinds of payments through various mechanisms, banking mechanisms, which we are going to see at a later time. Apart from these particular things, we have salary accounts. An individual, when he joins any organization, he is going to be provided by a particular bank wherein the businessman or the organization under which you are working will credit that particular your salary to that particular specified savings account, which is going to be called as savings account, salary account. It is also actually a replica of the savings account only which I am talking about. But in the savings account, you are going to maintain a certain balance of money, but in the salary account, you need not maintain any minimum balance criteria. The minimum balance criteria is not going to be there or applicable in the case of salary account. Then we can move on to the next type of account, which is going to be called as the current account. The current account is an account which is going to be used by the businessman. In this particular account, they will not be getting any interest, but this particular account is useful to make certain payments. So they have to maintain a certain balance of money for which they will not be giving any interest, but by maintaining that particular account, you will be allowed to make different kinds of payments. In a business organization, we will be making lot of payments actually. So we will not be able to understand how much balance I am going to maintain. So even the banker will not be able to understand how much balance he is going to maintain. So whenever I am going to give a check, actually that particular check has to be honored by the banker. So he will not be able to do any business with the money which you are going to keep it in a bank. So that is the reason he is not going to give any interest, because there is a lot of uncertainty with the amounts which are going to be there in the current account. At any moment of time, the money will come, any moment of time, the money will go out. So it is only for the convenience actually the current accounts are going to be maintained actually. So apart from this particular these two or three accounts, we have what is called term deposit. In the term deposit, actually, the individuals are going to deposit a certain amount for at a particular rate of interest for a particular tenure. That is, this is nothing but a fixed deposit, wherein I am going to deposit money for a certain period in a particular bank at a particular rate of interest. And usually the fixed deposit are going to be kept for a longer period of time. So these term deposits are going to be used both by the individuals and the corporates to keep excess cash to get more return. So this is a form of an investment which the individuals and the corporates make in the bank. And these banks are not going to be so much volatile when compared to the current account balances, current account deposits. Then we have something called zero balance accounts for salaried class, and nowadays Jan accounts are also being opened by the governments, individuals, because of the governmental intervention. Actually, the pensions are being credited to that particular accounts, and is also considered to be a zero balance accounts, which are going to be which are being opened for every individual in the country nowadays. Then apart from these particular things, we have the accounts, that is bank accounts for common man, which allow them to do various kinds of payments actually. So these are also coming when they check, this particular accounts also will not be having any check facilities actually, and they need not make any payment, they need not make any minimum balance also here. So there are wide varieties of bank deposits which are there. Depending upon the purpose, you are going to open different kinds of deposits. This being the part of the accounts and deposits, we need to understand something about the loan category, loan classifications. We have different kinds, the bankers usually, or the commercial banks usually, going for various kinds of loans to the various kinds of individuals, various kinds of entities. With regard to the individuals, they go and give personal loans actually. So depending upon the credit worthiness of individuals actually, depending upon the salary which the individual gets, and the spending habits actually, the personal loans are going to be given to individuals. Apart from these particular things, the bankers also give a lot of loans to businesses actually. We have the various kinds of business loans actually. There are certain loans which are given for the purchase of the fixed assets. There are certain loans which are given for the purchase of working capital. Banks usually give more loans to the working capital purposes, because the banks doesn't know, they cannot lend for long term. It is the financial institutions which can lend for long term, but the banks usually cannot lend for long term because their deposits are volatile. They cannot, these particular deposits which are coming to the banking sector are not going to be there for a long term purpose. So that is the reason actually the loans given by the bankers also are going to be for medium term and the short term rather than long term purposes. We have the various kinds of loans. We have the housing loans, car loans, education loans, mortgage loans, specific loans sponsored by the government wherein some subsidy is also given, subsidy comes, and the interest is subsidized in this particular case, wherein the government pays that particular interest to the bankers actually. And there are going to be crop loans to the agriculture farms. Apart from these particular things actually, we have something very much beautiful which is nowadays catching up in India, and which has already catched up in India, which is nothing but credit card loans. A credit card, what is a credit card actually? A credit card is a thin rectangular plastic card issued by the financial institution, which lets you to borrow certain funds from the bank itself. Through it can be used as an ATM card. We can draw the funds from any ATM. Apart from this particular thing, the card can be swiped with at any business entity, a business organization, wherein you wanted to buy something actually. So the credit cards are the cards which are indirectly providing loans to you. So there is whenever a credit card is issued by a banker, it specifies the limit within which you can spend. That is what is called pre-approved limit for every credit card given, there will be a pre-approved limit within which you can make certain payments. And this is what is called a credit card. Of this particular credit card holder can buy the goods from the open market, and pay the amount at a later date actually. So indirectly you are being funded by somebody, and the other organization actually getting a benefit of selling something to you, though you don't have the money actually. It is nothing but a vendor financing indirectly, wherein it is a banker who is funding you to purchase certain items from outside for a certain period of time, and it is the retailer who gets the advantage of selling something to you, and because of that the retailer is going to pay a certain amount of money to the banker, and the banker in turn will not be charging anything to me up to a particular time limit. So these credit cards are nothing but indirect loans given to you and helping you to make various kinds of payments. So these are some types of loans which we need to know. Apart from these particular things, the banks are also involving themselves in many other activities to increase their business. They provide you safe deposit lockers. They are also maintaining depository services. They are also helping you in trading in stocks and bonds. They provide what is called trading services. They become the members of NSE or the BSE. They act as a broker to buy and sell securities for you. They also nowadays are providing investment advisory services to the various individuals, particularly high net worth clientele. Whenever they have the more funds, they will go to these particular bankers to understand which are the best investment options available in the market. The bankers help them in advising them. Apart from this, there are certain banks which also have or deal with what is called the PMS service. What is the PMS service? The portfolio management services. They give what is called portfolio management services, wherein the individual deposit certain amount, and this particular money in turn will be invested in various categories of investments by the banker to give, and you need not bother about the funds, how they are managed. It is the banker who takes responsibility of managing your funds. So they manage your funds. This is called portfolio management service, which most of the banks are doing nowadays. So this is all about the retail banking. Apart from this retail banking, actually, some banks are involved with what is known as wholesale banking. The wholesale banking refers to doing business with the various corporate entities. The wholesale banking refers to doing banking business with industrial and business entities. In the retail banking, the banks deal with individuals. Here they deal with the corporate entities, and they also deal with the various trading houses, which might be local trading houses or international trading houses. So what they do in this particular wholesale banking, they provide two types of services to the corporates. One is called the fund-based services. Other one is called non-fund based services. What do you mean by fund based services actually? Wherein the corporates are given certain funds for their operations. The corporates are given short-term loans. They are going to give short-term loans. They are going to give working capital loans in the form of cash credits and the overdrafts. Apart from these particular things, they also help them in providing funds on the export bills, which is called export credit. So apart from these particular things, these certain banks also discount the export bills and also the local bills to help the corporates in getting the funds required at a particular moment of time, These are the various fund-based services. Apart from this particular fund-based services, they involve themselves with non-fund-based services. So these banks actually provide bank guarantees to some corporate entity. What is a bank guarantee? A letter issued to understand that corporate entity is good or bad. They guarantee the funding. That is, they guarantee the payment on behalf of the corporate. If the corporate is going to fail, the banker has to pay. So they issue letters of credit on behalf of this particular individual to some other individual. On the basis of the letter of credit, actually, some other party is going to give goods to this particular individual corporate. So whenever you are going to import something from foreign entity, the other party, the third party in the foreign country may not be knowing the creditworthiness of this particular individual. So on behalf of this particular individual, I am going to give a letter of credit to some other individual so that that fellow believes that he gets the payment in time. Otherwise, this is the banker who is going to make me a payment. So the bankers, a lot of interest is there in this particular document, and international transactions are dependent on this particular letter of credit only nowadays, because the people the two entities who are there in two different countries may not believe each other, so they expect that they get a letter of credit before shipping their goods to this particular other entity. So there are apart from this particular thing, actually the collection of funds are also going to be done by the bankers, particularly when the overseas bills need to be collected. The bankers may be employed, and the corporates may employ a particular banker to collect the funds on their behalf. So these are the various kinds of non-fund based activities wherein it doesn't involve any funds, but it helps the various corporates, and these particular banks will charge certain amount on the basis of the size of the transaction. So apart from this particular two things which I am talking, which I have talked, one is about fund-based services and non-fund-based services. There are other activities which the banks are involved when they are going for this particular wholesale banking, which is called the value-based services. For example, nowadays the banks are actually helping the corporates in managing their cash, and they are also helping. That is, what do you mean by cash management services? Some banks are giving cash management services actually. So cash management services are the services wherein when there are going to be, when a lot of receivables are going to be there, these particular receivables are going to be managed by a particular banker. There are going to be vendor financing. The banks are usually help in mobilizing large funds by catching hold of different other banks. Actually, this is what is called syndication, bank syndication or syndication services, wherein a particular bank will help a particular corporate entity in mobilizing funds by tying up with various other kinds of financial institutions, other banking institutions. Actually, instead of you going to the different banks for mobilizing funds, a particular bank, say X bank, say SBI, will go to some other banks and try to explain my requirements and say that I'm interested in lending this particular person to the extent of 10%, which is equivalent to 100 crores, and they require around 500 crores, and what is that you can lend. So this particular bank will help in mobilizing funds from various other banks actually, and pushing that particular funds ultimately to this particular corporate entity. This is what is called loan syndication, syndicated loans. Then we have what is called Forex Desk, wherein they convert the dollars, one currency into other currency. I might require dollars, or I might wanted to sell the dollars actually. Sometimes I might, as an importer, I require the foreign currency. As an exporter, I might be receiving dollars or some other currency. I wanted to convert that particular thing to rupees. So this is also going to be done by the banker. So apart from these particular things, they might maintain my employees' trusts. They might make my payments, tax payments. So they act as a merchant banker to help mobilize funds. They help not only these particular things, actually they help in transferring my money to some other individual, that is through national electronic fund transfer mechanisms and real-time settlements, RTGS. So there are various mechanisms which help the corporate in transferring the money from one branch to the other branch, one person to the other person. So there are various kinds of various types of services that the bankers are giving nowadays to the various corporates. Apart from these particular things, as you all know, they are also providing what is known as internet banking services, and through the establishment of a proper payment gateway, the individual or a corporate entity, householder or a corporate entity, is able to transfer his funds to some other individual very easily. This apart, actually, they are also helping the various supply management partners like Paytms and Google Pay. These are actually, some are wallets and some are payment mechanisms. And these particular payment mechanisms are successful only because these particular corporates are helping them. They help in putting my money into a particular wallet, a digital wallet, through which we are making certain payments. So these banks act as a supply chain partner through which an individual or a corporate entity is able to use a digital wallet. So this is a major function any banker is doing in the modern world. These are the some functions, areas which many banks are involved, helping the various corporates. This is what is called the wholesale banking activities. Apart from these particular things, actually, some banks are also involved with international banking activities. What are these particular international banking activities? The international banking activities can be divided into what is known as export packing credit. The banker might be giving certain loans to an exporter to manufacture and sell to somebody outside the country. This is what is called export packaging credit, wherein this particular individual is provided with necessary funds to manufacture a particular item and sell it to some other individual who is there in a foreign country. We have other things like export bill negotiation. We have export bill purchase and discounting. Usually, this is a very important thing actually. When you are selling somebody, an outsider, certain goods actually, he will be giving you a bill, a negotiable bill, a bill of exchange. And this particular exporter has to wait for 3 months or 6 months, but he cannot wait usually. So he goes to the banker and discounts that particular bill. And apart from these particular things, the bankers also help in collecting the export bills. Apart from this, the bankers also help in giving bank guarantees. As I already discussed, the bank guarantees are going to be given when an importer wanted to import something from a foreign country. The other party may not be believing this particular individual because he might not be understanding the creditworthiness of that particular individual. So the third party, the exporter in the other country, might be requesting this particular importer to give a bank guarantee. And these banks will provide a bank guarantee to the third party so that he will be confident about getting the foreign currency on behalf of this particular importer whenever he fails to make a payment on the due date. Then apart from these particular things, this particular bankers also help in rupee advances against export bills. So they lend in local money, advance money in local currency whenever the foreign bills are going to be there. So there are suppliers credit, there are many other things actually which bankers are involved in this particular international banking activities. This being the various activities done by the commercial banks which help the robust development of the money market. We have some other financial institutions which are equally prominent in making the money market vibrant. They are called Nbfcs. These financial institutions are called the Nbfcs. What is Nbfc? Non-banking financial institutions. What are these particular non-banking financial institutions? These non-banking financial institutions actually are involved with a different kind of functions which are not the functions of any commercial bank. When in a commercial banks, actually the commercial banks borrow and lend. Borrow in the form of a deposit and lend it to some other individual. The basic difference between a banker and an NBFC is that these NBFCs will not provide a check facility for the deposit they collect. And usually these particular deposits collected by NBFCs are going to be for a long-term purpose, long-term tenure. And these people also borrow and lend. Either they lend from their own corpus, or they might lend it from the deposits made by the public. So there are different kinds of NBFCs which specifically perform a particular activity. These are non-banking financial institutions which cater and carries on a business or part of a business relating to the financing or acquiring of shares, acquiring of stocks, acquiring of bonds, acquiring of debentures, acquiring of securities issued by government or local authority, or letting or delivering any goods to hirer on a hire purchase agreement. Some are also involved with insurance business. So basically the scope of the NBFCs has grown wilder over a period of time. They are doing many types of activities. So basically these particular NBFCs actually lend money to the corporate entities. They lend money to the corporates in the form of mortgaging the physical assets or mortgaging the floating assets in particular. So they are doing a lot of activities in financing the various corporates. Their size of funding has grown over a period of time. They give long-term loans, they medium-term loans, short-term loans. They create high charge against the goods. They create charge against physical assets and give loans to the various entities. So they are actually giving different kinds of loans. They are involved with loans relating to leasing also. There are leasing institutions also, wherein they buy the plant and machinery not for themselves but to lease out to some other persons. So they lease out the various kinds of machinery that is required for the other individual. They buy the commodity, they buy the various fixed assets to help others. So instead of giving directly the finance required for the other party to buy a particular commodity, particular asset, these leasing organizations buy the various fixed assets in their own name and give it to some other individual to collect lease rentals. So this is lease financing. So there are various kinds of NBFCs which are existing in India. So these NBFCs some are controlled by Reserve Bank of India, some are not controlled by Reserve Bank of India. For example, we have investment companies, we have loan companies, we have hire purchasing finance companies, we have equipment lease financing, leasing companies, and we have the mutual benefit finance companies. We have the gold companies, actually gold loan companies. So, and we have specific housing finance companies. We have specific companies which are dealing only with microfinance. So there are wide number of NBFCs which are working in the money market in India, who are specializing themselves in a specific activity. For example, Muthoot Finance is there, Manappuram Finance is there. It is one type of NBFC actually. We have the India Bulls financing company. So there are different companies which are specializing in different areas. Some are financing housing loans, some are financing individuals to buy the houses, some are financing helping the individuals buy various commodities. For example, Bajaj Finance is there. It is indirectly financing the retailers to buy various gadgets from the various retailers actually. So whenever you wanted to buy a washing machine, or whenever you wanted to buy a refrigerator or a computer, this Bajaj Finance fellow will come in, say that I am going to fund you. You can take that particular commodity and I am going to fund you, and you can pay that particular amount later. So these are certain financial institutions which are working in the money market. These money market actually have a lot of space in the money market. Apart from this particular two institutions which I am talking about, there are certain other agencies, other organizations like the chit funds, or like the cooperative banks, like rural regional banks. They also perform different activities in the money market. Thank you.